Hi, I'm Lorna Illingsworth, an independent financial advisor for Protection Investment Southampton. Today we're going to discuss what are your options if you can't remortgage. When your current mortgage deal comes to an end, or you need to borrow more against your property, remortgaging is often the next step. But what happens if you try to remortgage and lenders say no? This is something more homeowners are experiencing, particularly after recent interest rate increases and tighter affordability checks. The term mortgage prisoner is used to describe homeowners who find it difficult or impossible to move away from their lender's standard variable rate once their fixed deal ends. This often happens because lending rules are now stricter than when they originally took the mortgage out, or because the lender no longer offers new mortgage products. As a result, some people are left paying higher interest rates with limited ability to switch or move home. There are a few common reasons why a remortgage application may not be approved, even if you've kept up with your mortgage payments, such as changes to affordability. Lenders reassess affordability every time you apply. Changes such as a higher household bill, reduction in income, becoming self-employed, or having additional dependents can all affect how much you're able to borrow. Interest rates are higher than they were in the past, and lenders now apply tougher stress tests. This means they check whether you could still afford your mortgage if rates increased further, which can limit borrowing even if nothing else has changed. If your mortgage balance is high compared to the value of your property, or if property prices have fallen, your loan to value may be too high for many lenders' criteria. Missed payment, arrears, or other adverse credit on your record can reduce your options or result in higher interest rates being offered. If you're close to the end of your mortgage term or the remaining balance is relatively small, some lenders may decide that remortgaging isn't cost effective once fees are taken into account. Not being able to remortgage doesn't automatically mean you're out of options. In some cases, your existing lender may still offer a new deal through a product transfer, which often avoids a full affordability assessment and can be the simplest route forward. You may also be able to make changes to the structure of your mortgage. For example, extending the term could reduce your mortgage payments, although this would increase the total amount of interest you pay over time. Certain situations, switching to interest only or part interest only may be possible, although this will depend on the lender's criteria and your long-term repayment plan. Improving your financial position can also help. Reducing unsecured debts, avoiding new credit, making overpayments where possible, and checking your credit report for errors can all strengthen future applications. Every lender has a different criteria, and some specialise in areas like self-employed income or adverse credit. Working with a whole-of-market mortgage advisor can help identify lenders you may not be aware of and avoid unnecessary declined applications. If you're struggling to keep up with repayments, it's important to speak to your lender as early as possible. They may be able to offer temporary support. You may also find free guidance helpful from organisations such as Citizens Advice or Step Change. Remember, your mortgage is a secured loan and missing payments could ultimately put your home at risk. If you're struggling to remortgage, please call us on 02380 668 407 or visit our website.